Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts in the world. My name's Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. We've got a great episode for you today. Andrew Thrasher is going to be joining us. Andrew is a portfolio manager at Financial Enhancement Group. He just won his second Dow Award for his research paper on pullbacks, which we'll be talking about. But he won his first Dow Award for his research on the VIX. And of course, the VIX has been getting a lot of attention this week. So we wanted to bring on an expert to help us make sense of it. And Andrew knows more about volatility than just about anyone out there. But before we talk to Andrew, it's Friday. The markets are closed. So let's take a quick look at how this week played out. Hey guys, thanks for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. So it was a pretty boring week with the S&P 500 pretty much unchanged since last Friday. The Russell 2000 led, gaining a little more than 0.5%, while the NASDAQ lagged, falling about 0.5%. It's nice to see small caps continuing to lead, considering how poorly they did in March compared to the NASDAQ. So even though they didn't move much this week, it's constructive to see some rotation out of the NASDAQ and into the Russell 2000. Now, taking a closer look at the S&P 500, this pause is happening at a major inflection point. This 4,200 level continues to be the level everybody's watching. We couldn't do it this week, but we're right there, so bulls will get another chance next week, and we'll see if we can finally get some resolution there. Looking at the sector performance this week, 6 of the 11 sectors closed higher. Consumer staples led, rising about 1.8%. Communications and energy lagged, with both falling a little more than 2.5%. Anyway, that's enough from me. Let's welcome Andrew onto the show. Andrew, welcome to the show, and thanks for coming on today.
Thanks for having me. It's great to be here.
Yeah, first off, congratulations on winning the Dow Award for your second time around. I read the paper last night, and I got to tell you, it was really interesting and very well done and very well deserved. So congratulations.
I appreciate that.
Yeah, and we're going to talk about the paper a little more in a second. But before we do that, I got to ask you about the VIX. You actually won your first Dow Award on a paper that you did about the VIX and volatility. And everyone loves to talk about the VIX, but I don't think many people understand it as well as you do. So I want to get your perspective on it. It's getting a lot of attention this week. We're hitting new 52-week lows. It's getting a small bounce here today, but we did see those 52-week lows this week. And we're recording this on Thursday, so things could change by Friday. But I keep hearing that the VIX is broken. Some of the distortions that short-term options may or may not be causing. But when you look at other volatility indicators, like here we have the average true range, something that's not affected by short-term options, it's saying the same thing as the VIX.
Right.
So I'm wondering, when you hear those claims, the VIX is broken, what do you think of that?
Yeah, so the whole idea that the VIX was broken, it stems from the kind of the popularity now of 0 days to expiration options. And so VIX is looking at the volatility of the S&P options out for the next month. And so when these got popular, the 0 days expiration kind of shortens the window of a lot of the options that are getting traded. And so people are saying, well, then the VIX isn't really picking up on that activity, and so the VIX must be broken. And so we kind of heard something similar back in 2017, which was the year that I first won the Dow Award for my VIX paper. And of course, it was 2017. If you were around trading, if anyone was around trading, then it was basically the year of no volatility. So of course, I wrote a paper about volatility spikes. We had absolutely no volatility. And during that period, everyone was like, well, the VIX is broken. And at that time, the reason was all these VIX ETNs. We had XIV, which imploded, and VXX, and everyone was kind of piling into these VIX ETFs, primarily the short ones, because shorting volatility became such a profitable trade during that time. And then we had Volmageddon in February of 2018, kind of cleared the decks. and magically VIX was no longer broken and everything worked out fine. So I think it's probably something similar, like you showed. Volatility has just been really low. That doesn't mean that the instrument's broken. We just really haven't had a lot of volatility this year. We're in April, almost through April, and we've had kind of really one, if you want to call it a spike, one really significant up move in volatility this year. It's just been a really low volatile year. That doesn't mean it's broken.
Yeah, I like what you said there. Basically, we've heard those claims before. And all it really means kind of is that the market's been relatively quiet. But I want to get your interpretation on what these new lows mean for the VIX. And what would you like to see as confirmation that we are entering a low volatility regime?
Yeah, so something I actually wrote about in my paper, the first one, Forecasted Volatility Tsunami, was looking at what were the type of environments or conditions that preceded major spikes in volatility. That was really what I want to know as a portfolio manager. I want to know when volatility is likely to spike. When is that risk the highest? And so in the paper I look at, is it when volatility has large declines? Or is it when volatility is at a really low level? And I found that the answer was really no. So the fact that VIX is at a 52-week low, to me, is insignificant. It's just the fact that over the last 52-week period, it's the lowest it's been. We could go back further and find lower periods. We've seen VIX in the single digits. We're nowhere near that level. So just kind of depends on what your look back period is to determine is VIX low. If you look back, again, 2017, when we were at single digits, VIX right now, just under 18, 16, getting in the 16s, is still pretty high. It's just we're looking at shorter periods, so it looks low. So what I found, to answer your question, is, again, what that paper discussed was when you look for very tight consolidations and standard deviation, which is dispersion. So when dispersion gets really, really tight, when you don't really see volatility moving a lot, those are the types of conditions that precede large spikes in volatility. I mentioned earlier how we've really only seen one period in 2023 that volatility moved up. You can kind of see it there on your chart that you have on the screen. Right before that period, we had standard deviation get really, really low, and it kind of built up of pressure, and then it gets released by volatility moving higher. And that's pretty much what we see almost every time the VIX does move up, is it preceded by these consolidations. So looking at the market today, we're not seeing that right now. We're not seeing consolidation and standard deviation and that dispersion. So I don't think we're at as high of a risk. Volatility is really low. You look at it from a mean reversion perspective, it's pretty stretched. But I don't think we're kind of in that environment that is ripe for a major spike higher.
Yeah, and I know you look at the volatility of the volatility index, the VVIX. So I'm wondering if you're monitoring anything there. What are you looking for, if anything, there?
Yeah, so I think this is definitely a chart I keep an eye on, looking at the VVIX versus the VIX. So when volatility of the VIX starts moving higher, that can be a kind of a bullish setup for the VIX. Similarly, like when you start seeing VIX start to rise along with equities, it's not a normal condition, and so it should kind of raise a flag to some degree. So I view it as kind of a secondary type indicator or type of chart. I'm not going to act alone on just the fact that the VVIX is making a higher low, but it definitely perks my ears and makes me kind of pay attention to what's going on in volatility. This is telling us that there is some activity in the VIX options, because again, VVIX is measuring volatility of the VIX pretty much the same way that VIX is measuring volatility for the S&P 500. And so what this is telling us is there's an increase in activity. And if we actually dug a little further, I know we don't have a chart of this, so people just kind of have to use their imagination. We're actually seeing a lot of VIX call options get traded. The open interest in VIX calls is gone up pretty significantly. And so we are seeing, it seems like a lot of people are starting to try maybe potentially hedge with cheap VIX calls. You obviously don't know the underlying reason why someone's buying them, but we are seeing a rise in VIX call activity. That's probably leading now the VVIX moving higher. And maybe it does lead to the VIX moving higher as well. But we'll kind of know after the fact if that was the case.
Yeah, and I wanted to bring that up too, because I don't know if you remember, but it was February 11th, 2020, I believe, because it was like a week before the market peaked, before that massive decline in COVID. Yeah. And you pointed out, we used it for chart of the day, a divergence between the VVIX and the VIX. You can kind of see it over here in 2020. The VVIX, the VIX made a new low, but the VVIX didn't. And that kind of told you something might be up there. And of course, what followed was one of the sharpest declines in recent market history.
Yeah,
That was an interesting one.
Yeah, we had consolidation in VIX during that time period. Starting kind of in November of 2019, we started getting, you kind of see it on the chart there, where the VIX really got really calm at the very tail end of 2019. And of course, like you said, we didn't know it was going to be a world shut down by a pandemic, but we did have kind of the ingredients where you had consolidation and volatility. You started having VVIX pick up. You had all these kind of different symptoms that said, hey, something's going on in the financial markets. And the release of it was the COVID crash. But thankfully, we didn't have to be epidemiologists to know that was going to happen. But we knew that there was something kind of going on. And it obviously got exacerbated by that. But something was kind of starting to build in volatility during that time.
Right. The conditions were in place for something to happen. Obviously, it wasn't predicting an epidemic, but the conditions were there. But I got one more random question for you. Yeah. I've asked a few people about this. It's just a total head scratcher to me. I think it was Steve Straza actually pointed this out originally to me. The VIX looks pretty much exactly like the US dollar versus the Mexican peso. I mean, the two are almost trading in lockstep. And I'm wondering if you had any thoughts on that, maybe any potential ideas for why that correlation might exist.
Yeah, it's really, and it doesn't, now that you say who created it, that doesn't surprise me. They're always doing really unique stuff with stuff like this. That makes sense. I've never seen anyone compare, or that I can remember, the US dollar to peso cross to the VIX. I assume it's probably just, it's be boiled probably down to just being a risk on, risk off currency pairing. It's interesting right now. It's kind of breaking down really that correlation's kind of the midsummer of last year. It doesn't really look like it's that tight of a correlation anymore. But that's an interesting chart. I hadn't seen that one done before.
And hey, it is breaking two multi-year lows, whereas the VIX isn't quite there yet. So hopefully that continues, and hopefully it is a canary in the coal mine, not to lead to our next topics. But as far as the broader market goes, are there any specific levels or indicators or specific areas of the market that you're watching right now?
Yeah, so the market's pretty much been in this range. We've kind of been right between 4,200, 3,800 roughly. We're for the large caps. We're seeing small caps break down a little bit more. Micro caps breaking down more than that. But from a S&P perspective, we're just kind of in this range. And I'm a little bit intermediate, longer term focused. I'm not trying to day or swing trade this range. So kind of sitting and being patient. It is concerning looking at the chart you got on the screen right now. The fact that we did really see micro caps and small caps break down significantly like they did. It's encouraging now. Micro caps are bouncing back. But they're still significantly under the 200-day moving average. Interesting in looking at small caps are as well from both Russell 2000 and S&P 600. And that was actually one of the charts that I used at the start of last year that kind of was helping show my bearishness at the start of 2022 was that we very rarely saw small caps under the 200-day moving average when the S&P was hitting 52-week highs, which is what was happening at the start of last year. And really the only times that it happened preceded some pretty significant declines. And then we saw what happened in 2022. So just to say, I think it's important to watch how the asset sizes are performing. And so when we start seeing small and micro caps break down like this, that's not overly bullish, but it hasn't really gotten response yet from the large caps as they're getting held up kind of by a lot of the mega cap names. But we're kind of in this consolidation, looking to see if we get some breakouts above like the 4,200-ish level. 4,300 would be above like the August highs. 4,200 would be the February highs. I'd like to see a more directional move before getting overly bearish or overly bullish until this consolidation finishes playing out.
Yeah, it seems like all eyes are on that 4,200 level. So anyway, I want to move on to your research paper. You called it the 5% canary. And it won you the Dow Award this year. And it was really fascinating. You basically looked at 5% pullbacks in the S&P 500 and the broader indexes, a 5% pullback from a 52-week high. And you were really looking at the speed at which those happened to determine whether or not it was a canary in the coal mine, a precursor to a larger decline or a buy the dip kind of opportunity, right?
Yeah, so it's a pretty simple concept. I mean, my VIX paper was too. I was looking at compressions and standard deviations. And I think it's important to recognize there's so many different ways to make the market's complicated, to make technical analysis complicated, and it really doesn't have to be. So like you said, my paper, the 5% canary, is looking at 5% declines. And we'll kind of maybe from the beginning, what started that was reading that really interesting, I guess you'd call it interesting, about a math problem from 1696 from Johann Bernoulli, looking at what's the fastest way between 2 points. It's common, most people think, oh, it must be a straight line. That's the most efficient way to get between two straight from point A to point B, but it's actually not the fastest. And so I put the curve that you have there on the screen, and that was kind of the solution to the problem. And what I connected to it was that what made it the fastest was it had that really steep slope at the very beginning. So like on that chart, it was if you drop 3 balls, which was the one that got to the far right side the fastest. And it was that red line because it had that really fast slope at the start. And so and I think probably a lot of technicians are like this. You read something, you see something, and you say, how do I apply this to the market? It's like seeing ticker symbols and people's license plates that you're just always looking at. How do you apply this to the markets? And so I started thinking, well, is there anything in that data that says, well, really fast starts to a decline or a rise are significant? And so I just went down that rabbit hole and found that we did see that when the market had kind of a quick initial drop, that preceded a lot of our major declines that we've had going forward. And so that's why I kind of call it the 5% canary, because you kind of that after that first 5%, we had a kind of a rough idea: is the market preceding a material decline, or is this maybe an opportunity to take advantage from the buy side?
So let's break it down kind of section by section. So first, you started off the paper by defining this 5% canary, as you called it, and that's kind of the most basic measure of it. So what exactly is that?
Yeah, so 5% canary was a 5% decline from a 52-week high. And the paper, I focused on the S&P 500 and the Dow Jones Industrial Average, because they had a lot of data history there for me to work with. And for it to happen within a 15-day period, essentially 3 weeks, 3 weeks of trading days. And so if we got that to occur, then that gave us the 5% canary, saying, okay, this is setting up, this has been a pretty quick decline. And you see by the red lines there, it's happened quite often. And so when looking at data, you don't want something where it's only happened 4 times. And by chance, it was all the 4 times that preceded, like Black Monday, the crash of COVID, and the tech wreck. And just by chance, those are the only times it ever happened. That's kind of data mining. So the first step is really, you want to have a lot of data to work with, a good sample size. And that's with all these red lines, each time that happens. But a lot of them did happen at major market moving points. And so from there, and you can see it on the.
Yeah, I think this is a great illustration of that concept too. You basically on the x-axis here you have time, right? And then on the y-axis you have the subsequent decline after the 5% decline, right? And you can kind of see that the shortest ones had the worst subsequent decline. Is that right?
Yeah, this was actually probably one of the very first charts when I just was starting to kind of look at the data after reading the problem. Just kind of threw it in a scatter plot and said, is there any kind of relationship here? Looking at, I start with 5% because I think that's a material enough of a move. You start looking at anything longer than that, then you're really limiting your sample size if you only look at 20% declines. And also as a portfolio manager, I'm looking at it from a risk management perspective that I can handle a 5% decline. I want to start managing risk for 15, 20 plus declines for our clients. And so look at the scatter plot and found, it kind of blew me away that all of the really big declines we've seen started this way. And I'm like, well, that's really cool. And so I started kind of going further into it. But this was actually probably the very first chart I made, just throwing the data in Excel and realizing there was a relationship there.
Yeah, and then you took it a step further, right? Because once you have all these signals, you want to kind of filter them for the best quality signals, right? Signals that give confirmation. So how did you do that? What is what you called a 5% confirmed canary?
Yeah, so often in technical analysis, we look at some maybe secondary data, an indicator that's doing something or something within the market, and then we want to look for price confirmation. And so maybe it's similar when we talk about that VVIX making a higher high. That's secondary. We want to start looking to see does volatility start responding to that. Same thing here. So if we have a 5% canary, we've gotten the the S&P in this instance dropped 5%, let's say in 10 days, gave us that 5% canary. Now we want to look for, does the market start to respond more to that through a possible change in trend? So we have that kind of have that momentum, that fast momentum's built up after that initial decline. Does it fall below the 200-day moving average within the next 2 months? And so that's what gave us that confirmation. And so we have a lot less. So that's what the red dots on that chart are. We can say we have a lot less of those 5% canaries got confirmed, which is what we want. Now we want to start, hopefully, not having a lot of these big declines.
Right.
But they started kind of pushing out the sampling to where we had a little bit less to work with. But when they did happen, they were pretty significant time periods from Black Monday. The 1987 crash had happened.
Oh, wow. Yeah. There's one right before 87 or maybe right after. I guess it would be the 5% that would have triggered it, right?
Yeah. If you look back at actually the 1987, the market didn't collapse from a high. The market actually had been going down for a little while before we actually had that big drop. It just on the chart, it looks like it just all happened right away. But the market actually had been declining for a little while. But it was really interesting. It happened right before the COVID crash. So again, you didn't have to be an epidemiologist, but it actually did happen before we had that COVID decline. Now the market recovered really, really quickly after that, but we had it before the 2018, like the chart you're showing here. It actually happened last year after the first 5% decline in 2022, and then we had that protracted decline in the equity market. And so it just gave us kind of this warning signal, again, kind of why I called it a canary, to say, okay, hey, something's going on in the market. Do we have other data that starts to confirm it? And then you can start building a little bit larger, thicker thesis or market opinion from there.
Yeah, and I like this one because it's basically just a zoomed in version of this one. Exactly. And just to note, those red dots are the confirmed canaries, whereas the vertical lines, those are just the 5% canaries. So again, Correct. Just a more refined signal. And break us down how the returns compare for a confirmed canary, one that closes a 5% pullback, that closes 2 consecutive closes beneath the 200-day. How does that compare to some of the other returns?
Yeah, so what I found was like the 3-month drawdown was almost double for confirmed canaries compared to just like a regular 5% decline, regardless of how long it took. And so what this tells us is that there's substance there, in that the market does see a larger decline when this occurs, outside of just anytime it declines by 5%, the average return maybe is XYZ. So these do kind of scrub and show that the largest declines do start this way. And we saw that kind of with the scatter plot, right? This just puts it kind of in a different format, looking at the bar chart, kind of just looking at the different time periods there of what the market does going forward. But it was basically double just a regular 5% pullback.
Yeah, and going back to this chart here, I think it is interesting because it is a pretty early warning sign. You called it a canary in the coal mine. For people who don't know where that term comes from, you explained it in the paper. Back in coal mines, they used to send a canary in because they can sniff out the gas. Right. And if the canary died, I know that's kind of dark, but if the canary died, that'd be a sign that there's toxic gas within the coal mine, right?
Yeah. And so the other kind of the counter to this is, well, what about just looking at the 200 moving average? Because all these are just crosses the 200. And we see that the market cross over. Thankfully, in the last 10 years, it hasn't happened a lot because the market's basically gone straight up, except for a few pullbacks. But when we look at long-term history, looking at just 200-day crossovers, it provides quite a bit of whipsaw. And so by having this additional filter to just looking at 200-day crossovers provides, in my view, a great filter to market weakness than just looking at that M&A crossover.
Yeah, so you established that this is a pretty good early warning sign for risk management, right? But how do we tell when a 5% pullback is buyable and that we actually want to buy that thing, right? You had the criteria for that. So when is it buy the dip?
Yeah, so I think, whenever you have, when I try to look at a different market system or a signal, if you have something that starts out as bearish, does the opposite of it turn out to be bullish? So in this instance, when we have a market pull back 5% and it takes longer than 15 days, so it doesn't qualify as our 5% canary, and instead of 15 days, it takes maybe a full month, 21 days. to decline. So it took a longer time to reach 5%. What I found is because it was a slower momentum decline, it took a lot longer, that there's really not a lot of force behind that decline. It actually creates an opportunity maybe just to buy the dip. A term that got really popular kind of in 2020 and 2021, when every time the market had any type of pullback, buying the dip was a great strategy until it wasn't. And even showed the comparison to Isaac Newton during the South Sea bubble, where he kept buying the dip, making tons of money for his trust, and then tried to do it after the bubble popped and lost everything. And so I thought this was kind of a way to help not only provide its own market view of possible buying the dip opportunities, but then helps confirm the 5% canaries in that the opposite actually provides a bullish thesis to the bearish thesis of the 5% canary. So yeah, 5% pullbacks that take longer than 15 days just don't have the same amount of force. And oftentimes you see buyers will step back into those types of markets.
And I wanted to ask, why 52-week highs? Why not all-time highs? Did you just want a bigger sample size?
Yeah, because you just have so many times where the market maybe isn't making all-time highs, whether it's like the 70s and 80s, just where it just maybe just grinding. So looking at just 52-week highs, I think that's pretty much I didn't really want to try to data snoop or try to really kind of curve fit it. So just saying that a 52-week high is probably going to be within an uptrend. And so you say the market, so looking at the kind of the psychology of the market, that in this uptrend, if it's heading to 52-week high and then has this pullback, that there must be a change in kind of the market psychology and this change in momentum that's kind of a break from the usual price action. Is it significant or is it not? And if it happens quickly, then I believe it is. If it takes a long period of time, then maybe the buyers, the bulls are still in charge, and those buyable dip opportunities could be attractive.
And how exactly did you define the buy the dips again?
Yeah, so 5% that takes longer than 15 days. So kind of if it doesn't fit the criteria of 5% canary, if it's happening within an uptrend.
Okay, and you defined an uptrend by the 50-day over the 200-day, right?
Yeah. Didn't really want to try to curve fit it with something fancy. Just a simple 50-day above the 200-day, we're in an uptrend. Trying to keep everything as super basic, uncomplicated as possible, which is an easy way to define uptrend in the market is the intermediate term moving average above the long term, probably an uptrend. Is it the most efficient? And that's what I kind of did with the VIX paper and this paper, where it creates a platform that people can take these concepts and kind of make it their own. Maybe you wanted to find an uptrend in a different format, and you easily could, and still take this idea and apply it to a different way to define an uptrend. But for the paper, 50 above the 200-day was an uptrend. Market pulls back 5%, takes a long time to do it. Probably not a protracted decline going forward.
Yeah, I think it was David Lundgren who said it once to me, the best trading systems are the ones that combine things like momentum and trend, maybe relative strength too, but this one definitely combines momentum and trend. That's what you're kind of doing here, right?
Yeah. So it's basically since 1980, the market was higher 67% of the time 2 weeks later. Market was higher 87% of the time 2 months later. And 2 months later, the market was up about 5.5%. And so when you
combine both, right?
Yeah. When you're looking at when you have these pullback Bible dips in an uptrend, the market historically was higher most of the time, 87% 2 months later.
Yeah, and I'm wondering if you could kind of delve a little further. You touched on it briefly, but about the psychology behind this, right? Why is it that a sharper, faster 5% pullback might cause more of a sell-off than, or might lead to more of a sell-off than kind of a slower drift pullback?
Yeah, it's a great question. So what I kind of look at the start of my paper was in the literature review was kind of the psychology of it, and found that studies have been done that when the market has these kind of big reactions, that's what draws in a lot more retail traders and just a lot more activity. And so they're pretty much also what studies found was that individual retail traders watch the indices more than individual stocks. So that was kind of why the focus of the paper was on the indices. And so when they see these larger moves and they start getting reported in the news more often, again, when these declines happen quickly, a 5% decline in roughly basically 3 weeks, is likely going to draw more attention. And with attention comes action, and action brings dollars. And in these cases, often on the supply side, and then kind of exacerbates the move lower. and can create then those downtrends.
Yeah, it kind of wakes them up and makes them feel like they have to act, makes them feel like they have to do something about it, right? Because
Exactly.
it is kind of a jarring move, right?
Yeah, exactly.
All right. Well, Andrew, I think we got to wrap it up now, but thank you so much for coming on the show and sharing your thoughts. And I'll see you in New York next weekend at the next week at the CMT Symposium.
Yeah, it should be great.
Yeah, and you know what? I'm gonna bring my copy. I want to get your autograph on it, so I'll be bugging you at some point there.
Definitely do. Look forward to seeing you there.
Yeah, you too. Have a great weekend. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.